China's on the brink of unleashing an unprecedented threat, and the ripple effects across the globe will be nothing short of catastrophic. Stay tuned. I'm your host, Steve Metre, and thanks for joining me today. In our show today, the alarm bells are ringing worldwide, and China is unready to unleash chaos, and with countries preempting tariffs, a major global catastrophe looms on the horizon. Plus, our latest big trade is on fire. Our momentum strategy is breaking the mold and delivering huge gains. And when it comes to trading momentum, we simply do it better. Stay tuned to the end of the show to find out how you too can get in our next big momentum trade. Now let's head over to Bloomberg, where we picked today's story up because China's got a major problem, and that is money's on the outflow, as they've recorded a foreign investment outflow of a whopping $168 billion. It's a mass exodus as money is fleeing out of the second largest economy in the world, and this is unprecedented because we haven't seen such a massive move of money in a long time, and there's reasons behind it. And what this is setting up is for China to unleash the unthinkable on the world. It's going to have major consequences, as you're about to see. Foreign investment in China weakened substantially last year, with the 826 billion yuan of new inflows being the lowest total since 2016. Beijing is keen to reverse that trend as they're meeting with Japanese business delegations this week in an attempt to boost bilateral business ties and investment, because for China, their two biggest trading partners are Japan and the United States. And obviously, President Trump applying additional 10% tariffs on China. They're looking to Japan for the answer. They need money to flow into their country because without it, they have a major problem. A lot of investment comes into China from outside sources. It drives their economy. Without it, their banking system as it stands is already in a state of insolvency. We know their property developers on the brink of outright collapse. And just to understand the size and scope of what's happening, it is massive because investment outflows are huge. And you can see inbound investment surge going into the pandemic, then plunge. But look at the outbound money here. It is just collapsing. And for good reason. People want their money out of China, and they want it out now because they believe things are going to get substantially worse. And we're going to talk about why they're getting worse, but more importantly, why Beijing is going to be forced to do the unthinkable. But let's look what's coming, because President Donald Trump has now imposed 10% tariffs on all Chinese products. And while China is hit back by retaliating in a number of areas, including into a probe of Google and blacklisting of Calvin Klein, it's not major compared to what we've done to them. And the slowdown in China's economy and rising geopolitical tensions have already led some companies to reduce their exposure. And this is the plan of the tariffs. This was the agenda, is look, if you want to manufacture in China, you're going to pay the price, or you can start manufacturing somewhere else, particularly here back at home, where you're not going to see the tariffs. And this is causing money to leave, but that's not the only reason, because China's economy is headed into recession. We've already talked about the banks and the property developers, but what are we seeing inside the manufacturing sector? We're seeing deflationary pulses at the same time. We're seeing rising inflation. What this is telling us is China's economy is on the brink of a stagflationary recession, and this is one that money doesn't want to sit around and wait to see happen. And this has caused the sentiment for investment into China to sour, as Beijing has cut interest rates well below most developed nations to stimulate the economy, giving multinationals more reason to keep cash outside China and resulting in a repatriation of funds that's likely masking some new investments. And this would have people believing that money's flowing out of China into U.S. bonds and stocks, but it's going somewhere else, somewhere safer, because what China is going to do is unleash something that not even the U.S. equity market, as you're about to see, is going to hold up to. But if you're looking to change the game when it comes to your trading, you're trying to trade momentum, one of the biggest issues people have is they buy in these oversold levels that I've circled here. And this is on our big trade on Brazil. Remember, Bank of America said this was the hottest sector and our subscribers were in it. But look what happens if you're just trading momentum signals. Price can go down, but we've changed the game because we have a proprietary overlay that we recently revamped. It's massively improved our signals and our trades, and you too can get in on this. And here's the best part, there's a 30-day free trial. Hit the links in the description below, grab that coupon code, stay tuned to the end of the show for more information, because where Capital Flight story gets really interesting is when we look at the Chinese public and private entities we're doing with U.S. assets according to official treasury data. And what we find is, according to the TIC data, in December, Chinese investors sold $14 billion in U.S. securities. That means bonds, mortgage-backed securities, corporate bonds, and stocks, and more notably, following a record sale in May, say, China's been a constant seller of U.S. securities over the past 6 months. So despite the fact that many people think that that's where money's flowing, it's not going there at all. Now, what's even more interesting is the reaction in their currency. Many people would think the Chinese yuan would outright plunge. Well, it's gone just the opposite direction. And what we've seen is a surge in the U.S. Chinese spot price, as one would expect when there's capital flight, most likely driven by rising fears of Trump tariffs and the implicit devaluation of the yuan would suffer in order to offset the tariffs, which according to Trump would start around 10% and likely are going to go higher. And so now we see the reaction in China's currency markets is setting up for them to do the unthinkable. It's as if all the major players in China's economy know this and they want their money out before Beijing does the unthinkable, and that is devalue the yuan. And if you don't think this is going to happen, well, they did it back in 2015, and now they have every reason to, because with these tariffs, they're going to see demand go down even more. They don't have enough internal demand from their own citizens to drive their economy. China has to do something. The only way out now is to devalue. It's only a matter of time before the currency devaluation advocates win, as they did back in 2015. No surprise that the biggest China-related story in recent months came from Reuters, and reported that Beijing is already planning how to devalue the yuan in response to Trump tariffs. And it makes perfect sense. You're going to charge tariffs on our goods, but we're going to devalue our currency and make them so much cheaper compared to the rest of the world that the tariffs won't matter. And you really think about China's options here. Yes, they could strike back and put tariffs on U.S. goods, but that really won't accomplish anything because they're the world's largest exporter and we're the world's largest importer. And that relationship means they need to see their goods flowing into our country. There's a simple answer to this, and that is devalue the yuan. And if you really want to see what capital flight from China really looks like, just wait until you see another 2015 style, quote, one-time devaluation. Now the question is, where is money in China going? It's going into gold. It's going into Bitcoin and other cryptocurrencies. That's what Chinese investors are pulling their money and doing, because they're looking for something that they believe will be immune to a massive devaluation. Now, why aren't they buying U.S. equities and bonds, despite the fact that U.S. investors, particularly retail investors, are buying equities at the fastest pace in history? Well, here's why. As we go back to 2015, let's take a look at the consumer price index. This shown in blue is the NASDAQ 100 because it was in August of 2015. So that's right here. And you can see starting in 2015, inflation was rising in the U.S. And that's exactly what we're likely to see now in the months to come. China devalues and sends inflation surging higher. Now, what's the problem is right now, U.S. consumers cannot afford higher prices. So a devaluation would send consumer prices here skyrocketing. And that's a dangerous problem because companies are already complaining about tariffs as it is. And what happened after China devalued? Well, stocks had a massive correction. They double bottom, money flooded in again before they came tumbling down against higher inflation. And why is that? Because we already know today that consumers cannot afford higher prices. So if you can imagine, if we went on a big run of rising inflation, what's going to happen? Demand's going to plummet. That means, of course, corporate earnings and profits are going to plunge as well. Market will have a reaction to that. But what about the bond market? Well, if we go back to late 2015, what happened? Two-year treasury yields surged on the news that China devalued, and then they came plunging down. And why did they come plunging down? Because financial conditions in the U.S. started to tighten as growth and inflation expectations started to plunge. But there's one thing that changed back in 2015 and 2016 is broadly the U.S. economy was strong enough to get through this. It didn't have a major impact on the labor market. But today, that's a whole different perspective, because if we see inflation go up and we see a further unwind in the labor market, we see more people go on the unemployment line, what China's next move threatens to do is plunge us right into a stagflationary recession alongside them. But let's talk about what's going on with tariffs, because Trump is now floating 25% on auto, drug, and chip tariffs, upping the threats in a major way. This is going to be a huge problem for American consumers and the rest of the world, as you're about to see, because we already know consumers can't afford it. When they cut back on demand, that means producers are going to cut back on labor. President Donald Trump said he would likely impose tariffs on automobile, semiconductor, and pharmaceutical imports of around 25%, with an announcement coming as soon as April 2nd in a move that would dramatically widen the president's trade war, and this would have an immediate impact on consumer prices. We would see them surge higher, and we start to look back to the manufacturing sector post-election, and what did I say? It appeared that they looked like they were building inventory. Well, now you see why there's such a mad rush in the factory sector to build products, get imports into the country. It's to get everything here before the tariffs hit, because you can immediately raise your prices, blame the tariffs, and you've had some goods at a lower price point that you can sell at a higher margin. And you can see that after that, though, there's a major concern, because yesterday we talked about how the New York manufacturing sector was booming today. But looking out 6 months, they're not expecting things to go well. In fact, they're already starting to lay people off and cut hours. And that all turns to what we're hearing now from Goldman. And tariffs are already a much more prominent feature of management discussion than at any point during the last trade war. And you think about why that was, because when President Trump took office his first term, the global economy was coming out of the slump. And what happened is we were in the early stages of a growth cycle, and the tariffs didn't have that much of an impact because they didn't slow down the trajectory of the economy. Now we're in a completely different picture. The global economy is slowing down, and corporate executives are starting to warn and say, look, we've got no answer to these tariffs. All we can do is try to front run them, bring up inventory, import a bunch of goods. But when we've already exhausted all the places we could store that and our ability to produce, well, we're in big trouble, because we already know consumers can't afford it. And Japan's exports are validating this as they rise at a faster clip, with Trump tariffs looming, looking to get goods out and into the U.S. before that 25% or more tariffs come on board. And I think there was a rush of demand for exports. Shipments clearly grew in the first half of the month before Trump administration began. And I don't think this kind of growth matches demand in the U.S. So once again here, we're seeing people in Japan admit the truth is they don't see the demand here. But it's not about demand. Again, it's about producing a good at a current price point, getting it into U.S. shores. When tariffs hit and prices go up, those goods are going to sell at a higher price. The problem we have is consumers can't afford them at their current price. Most certainly aren't going to be able to afford them at a higher price, meaning they're going to stagnate on shelves, and that is not a good sign. And it's quite possible that exports will decline along the road, and there's no question about that. The New York Manufacturing Survey validated. They say, look, demand's going to plunge in the coming 6 months, and we know that because there isn't enough demand to move the current inventory, let alone all the inventory that's coming in at higher prices. The cheap yen is a problem for Japanese consumers and businesses as it raises the cost of imported energy and food. So what are we seeing happen in Japan? The signs of stagflation building. So what are the manufacturers there saying? Look, we're trying to dump all this stuff onto U.S. shores now before the tariffs hit. And what happens after that? We don't see demand. And when you don't see demand, you have to lay people off. The problem for Japan, they're also seeing inflation rising. And Japan's currency has stayed weak even as the Bank of Japan has rolled back easy monetary settings over the last year with a series of global interest rate hikes. And what does that tell you? The central bankers have absolutely no control over currency, even though they think they do. And of course, the equity markets want to believe they do. And we make the case completely clear. They do not have control of their currency. Evidence right here for you. The government's added cash support for low-income households to help them cope with the cost of living crunch because they just don't have money. And that would be a hit to many workers in Japan, as auto-related companies, including material providers, employ 5.58 million people in the country, or 8.3% of the total workforce, mean at a time inflation rising in Japan that these tariffs would threaten to put millions of Japanese workers on the unemployment line right into a stagflationary recession. You're seeing here, my friends, in real time how global chaos is coming. And look how this has now impacted the U.S. economy as home builder sentiment finally drops. If you can imagine, it's been surging higher after the election, now to a 5-month low on tariff costs. And this is a big deal because reflecting growing concerns, the component of the NHHB's overall index measuring expectations for the next 6 months fell 13 points to 46, the biggest drop since the start of the pandemic. Meanwhile, components measuring present sales and traffic of prospective buyers also declined. So what do we see now? Consumers saying, look, we're not optimistic about the economy. We don't want to buy a home at these prices because we're not sure we're going to be able to make the payment on it. We're not sure we're going to have a job or the hours we need if we do have a job to make that payment. Home builders who are sitting on the largest inventory since the financial crisis, they've got a big problem here because prices for homes are going to go up, with 32% of appliances and 30% of softwood lumber coming from international trade. The uncertainty over the scale and scope of tariffs has builders further concerned about costs at a time they're seeing buyers walk away because they can't afford it. What is going to happen when prices of new homes go up even more? And given home prices are still near record highs across the country and mortgage rates will probably stay elevated for the foreseeable future, incentives may be losing their power with such a limited pool of eligible buyers. The share of builders who cut prices or use incentives both declined in February, but look for that to increase as they see fewer people buying and their inventory levels continue to get bigger. And you can see exactly what's coming for the housing market as we look at new privately owned housing units. That in blue is continued unemployment claims in red. There's a very specific reason why we're seeing demand from the housing sector decline is because the labor market in the U.S. is weakening, and now workers are expecting it to get worse. We can go back to the late 1980s into the 90s as the continued claims number rose. What happened? Housing starts plunged. You see that again in the early 2000s. The labor market unwound. Housing starts declined a bit, but it was thanks to the demand from baby boomers that turned that situation around. But by the time the financial crisis hit, well, it was game over for U.S. housing, as right around 2007 into 2008, continued claims skyrocket and housing starts plunge as housing prices crashed with it. And we've seen this happen before. When we head into a recession and home builders are sitting on a massive amount of inventory, they're going to slash prices. They're going to completely destroy the resale market. They'll have no choice because no one wants to buy. But something you should be buying, that is our Brazil trade. And as of close of business yesterday, this trade is now up 11.92%. Actually, I forgot to type it down here. It is up 11.92% for all our subscribers. And we give you the notes. And here's the great thing. If you're trading momentum, you're trying to time these signals, say, well, it got overbought on the RSI, so I'm going to buy here, and then price went down. And so you wait till the next time and you buy, and then price goes down. That's because you're trading it wrong. There is a key to trading momentum and trading it properly, and that is you need a proprietary overlay. We have that. It validates the trend, and it's what causes us some massive amounts of success that we're having and with our subscribers. Here's the report. Now, here's the best part. You don't have to actually read the report, but we give you the data if you like the data. But here's the bottom line. You get the report. We give you all the signals, but I go through the signals and tell you these are the trades I think have the best chance of success, and that's why we have such a great result with our subscription. We fully back tested it. We give you risk control levels. We give you a weekly update on all our positions, including how I trade my own money with my own reports. That's right. I trade right alongside you. I disclose my positions. Here's the best part. We're so confident that you can make money trading with us. We give you a 30-day free trial. Use the links in the description below and be sure to grab those coupon codes. With that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.